When it comes to valuing a business, I want to start at Valuation 101. I want the business owners to really wrap their head around what their business is really worth. In many cases, business owners have wild expectations, and I want this to be somewhat of a level-setting conversation. So how does someone begin to answer the question of what is their business worth?
I think, Timmy, I got to start with kind of clarifying what type of company it is. First, we're talking about a private company here, which means, they're not going to get the same valuations as a public company would, which is one of the mistakes that business owners make, is they know the valuations of companies in our industry on the public market, stocks. And they think, well, I can get the same multiples as those companies, or I can get kind of approach those valuations on a multiple basis just because I'm in that industry. That might apply a little bit like in very crazy, very high growth industries, new industries like AI. That's a rare exception, right? Most businesses that are not in AI have to deal with this valuation premium that's in the public market that doesn't exist in the private market. So that's the first thing that needs to be discussed. The second thing is, you might have some thoughts on this, Antonio, but where do these business owners get those notions in the first place? Right. And most of the time, in our experience, it's from anchoring on a deal they heard a friend of a friend did 5 years ago or 3 years ago, or there's a company that's similar to theirs in a tangential industry, and they heard about some crazy price. But that's all they really factor on or consider, right? They're not thinking about, okay, how different is that company to my company? How much, they don't even probably know how much the company prepared for a sale versus how much have I prepared for a sale to maximize value. And the other thing to think about, we'll get into, is the type of process that's used for business owners to sell drives valuation too. So a competitive full broad auction process will generally lead to a higher valuation at the end than if they sold to a one-off buyer. Those are some of the dynamics in the minds of us and also the prospects. They need to be educated ultimately on what they don't know. They think they know more than they do, right? And we have to come in and be the experts and kind of educate them and inform them. We agree with you, we know about that deal, but that is a different type of company, different profile, et cetera, et cetera.
Yeah, I think I want to build on that second point about how different these companies are. I would say the first thing to think about is scale of a company, right? If you saw a company with 80 million EBITDA selling for 600, 700 million, it's different than if you have a company with 1 or 2 million EBITDA. There's a very different scale. What does that mean? The risk profile of that company is different, right? You lose 1 or 2 customers, the smaller company might be in trouble. That doesn't affect as much the larger company, right? There's more predictability and consistency of cash flows of that recurring nature of the business. And so typically, companies that have more scale, more revenue, and more EBITDA, they tend to get higher multipliers, right? And so this is something that not everybody's familiar with, but it affects the ranges and the valuation expectations.
Yeah, and to your point, another thing that drives valuation is how diversified the customer base is. Another reason why these big companies they're publicly traded, another reason that gets this high valuation is they have a very diversified customer base. So if they lose one customer, it has almost no impact on their revenue, right? Whereas smaller private companies, they lose one customer, it might be 20% plus of their revenue in some cases. And that's a huge impact to the business. So that's risky to a buyer, and so they're going to lower the valuation accordingly. So the thing that management and business owners need to assess, maybe with an advisor, is what are the risks to our business in terms of lowering the valuation? What are the things that don't look great right now? We need to clean it up and prepare those shortcomings so that we can get to a place where we can get a maximum valuation when we do go through a sale. So that is something that where advisors like us come in and educate, inform, and say, this is the way it really works. You have preconceived notions, but often that's off of one anecdote from a few years ago when by the way, the market was really frothy 2 years ago when valuations were unrealistically high, and now it's normalized. So the valuations for your company 2 years ago are not going to be the same as they are today, all things being equal, just because the whole market valuations has taken a more realistic step down.
Most business owners are terribly sophisticated because they don't spend their career doing valuations. They spend their career making widgets or producing a service. Mm-hmm. They get into this conversation and they think, well, it's just a multiplier of revenue, multiplier of my EBITDA. They may or may not even know what multipliers to use. It sounds like risk has a direct correlation, risk management, risk mitigation, to the valuation. What other aspects have a direct correlation to the valuation?
Well, there's the industry they're in. The extreme example is AI is getting insane valuations right now, but old school companies that are family owned, third generation, been in business for decades, right? And they probably make widgets, for example. They grow 5% a year, but they have a 30% EBITDA margin. It's not going to get the same multiple or valuation bump that a high-tech, disruptive tech business like AI native company would have. So there's that whole spectrum, right? Fortunately, business owners aren't savvy enough in deal making like we are to know that these variations exist, not only with industries, but within companies within industries. Like another thing that drives these valuations is, okay, how does this company's margins compare to other margins in the industry? What's the industry average for all these margins and profitability?
As well as growth rates.
Growth rates. So this all weighs into valuation. And when a business owner thinks about, oh, my company's worth 50 million, they're just really grabbing a number, like an aspirational number a lot of times, and just waiting until they can get there.
So I want to step back on savviness. You made a good point. Not everybody does this, right? So when you talk about valuation corporate finance, there are typically two methods: the DCF, or discounted cash flows, which in very simple words, it's about looking at the future cash flows that a company will generate and understanding what those cash flows are worth today, right? Including a long-term terminal value of that company. And the other method is the multiples, industry multiples, market multiples. What I wanted to say is that most companies in this private company space, right? I'm not talking about publicly listed companies or value in stock prices, but in our world of privately owned companies that are selling, you usually work with multiples. So I think the DCF, the discounted cash flows, is a good exercise to run, to understand, to have another benchmark. But to Eddie's point, we've been just talking about multiples. Why? Because most companies are acquired on a multiple of EBITDA, or operating profits, and occasionally on a multiple of revenue, which is typically the example of software businesses that have a recurring revenue nature, right? And in some cases, and we've seen a few, companies have a nice top line, they have a nice gross margin, they don't have profits, they get valued on gross profits as well, right? Or at least there is a consideration about that. So I think what's interesting to whoever's watching this is understanding on the basis of what metrics will my company be valued. And I would say revenue, EBITDA are the primary metrics. Growth, as you said, the relative margins, or the percentage margin. And then there's a whole other theme that I would love to talk about, which is what is that business worth to the buyer? What are the synergies that the buyer is getting through that acquisition? And that can affect substantially the multiplier that we talked about.
So let's talk a little bit about that. Let's talk about synergies, because there's financial buyers and there's strategic buyers. Right. So let's just for a moment talk about maybe an example or a scenario where you can imagine or you have seen where 1 + 1 really did equal 20.
Well, we sold a company in 2023, family-owned cheese brand, Mexican cheese brand. Only had 4 million EBITDA. We end up running an auction process, only contacting other cheese companies, so pure strategic buyers. In fact, I wasn't on that mandate, but I don't believe any of those were even PE backed. If they were, they weren't as competitive. So what happened is the unbacked strategics could capture a lot more synergies after the transaction closes, because they can capture like redundant costs and so forth, headcount, and that can lead to a higher valuation all around. So ultimately, the team generated like 8 LOIs, 8 offers, and sold for it was an 85 million, so about 17 times EBITDA, which was a huge premium to what the client wanted. And the reason why it got that high is because of the captured synergies from the strategic buyers. Because they look at a longer term beyond what a financial buyer would look at, which financial buyers have like a 5 to 7 year holding period where they have to actually sell it again. And so they can't capture all the same synergies for that period of time.
So I want to build on this. this buyer, speaking about synergies, right? We always talk about synergies. Synergies on paper are immense. They're always great. But what are those synergies, right? Are you, cutting people, personnel after you? Okay, fine. Those are cost savings that you could call them synergies. In this specific case, that is an international buyer that by acquiring our client company gained market share in a very desirable market like the United States for that specific segment. So that was worth a lot to the buyer that ultimately offered the highest valuation. So to complete what you said, it is about synergies. I would argue you also made the point about the process, right? Scarcity, right? Who else is potentially looking to buy this company, right? And the fact that it was actually 9 LOIs that were brought in, and there were 9 qualified buyers looking at this. And ultimately, the decision was made based on who could offer the most for that company. And so the process in this case drove that premium valuation more than an opportunistic buyer that might, try and buy that company.
Right. So there was a process that was committed to. There was experts that knew what to look at. There was synergistic fits. There was a good, healthy EBITDA. There was a willing seller. There was definitely willing buyers. There was a marketplace created. What else should be added to that example that anyone listening to this should understand when it comes to valuation?
Let's say Eddie, our team.
Yeah, I mean, we're experts, and hire someone like us to. I think the advice we would give to any business owner that's toying with the idea of selling and not sure is just start preparing. If one of your top priorities is to maximize value, you don't hear the stories of all these companies that get huge valuation, but they hire someone, a consultant or a banker, months if not years in advance to start preparing the company to find out all the shortcomings, clean them all up. Like for example, diversify the customer base, reduce costs, increase margins. So it makes it more attractive to a buyer at the time of sale. And so many companies just kind of think they can just go put the for sale sign up and get a premium valuation. That's not the way it works.
I want to add one thing, which is having realistic expectations or reasonable expectations, right? This deal actually came in, you mentioned 17 times EBITDA, which is, I would say universally high for any industry.
Company only
but
for EBITDA.
Right, the expectation was 45 something percent less. The asking price was 45% less. So in this case, another thing that aligned in that process was that the seller wasn't looking for some crazy number that couldn't be supported by any analytics or data. They were looking for something, possibly high, but reasonable, right? And that's important when you venture into this, because ultimately the market will decide what your company is worth. But if you start from an unreasonable place just because your company is your baby and you think your baby is worth more than anything, that's not going to lead to a good outcome, in my opinion.
Yeah.
So reasonable, let's define reasonable a little bit. How can we tell if someone has an unreasonable expectation?
There's a lot of ways. When they start telling you, well, I want 50 million when my company's only 10 million in revenue. Okay, well, right there as a banker from experience, that's unrealistic. And then you start asking, well, you give them the feedback, and then depending on how they react, you can determine how flexible they are. I guess the bottom line, taking a step back, your company's only as valuable as the market or buyer pays for it, right? And so that dynamic is interesting for buyers because they want to pay as little as possible, and sellers want to sell for as much as possible. And so for a deal to get done, guess what? Both sides have to be flexible enough to compromise. And the number one reason that deals don't happen is because both sides, one or the other, or both, are too entrenched. And they drew the line, this is my last negotiating point. And they just stop negotiating. And they don't find a middle ground. And so that's where an advisor can come in, again, to advise the business owner on how does it really work? You have preconceived notion, how does it really work?
So I want to add that we developed a little system. It's internal. It's 12 data points that we look at. And obviously, we talked about revenue, EBITDA, growth, margins, right? But there's a few others that we look at. And this can be done in the first meeting, in the first discussion that we have, right? We can quickly capture that and understanding, is this company sellable? say any company is probably sellable, but is there, because there could be a lifestyle buyer that is interested in that particular company, but sellable as in, is there a group of buyers that would see that company material enough to be acquired, right? Two, what is this company worth, right? And in addition to the metrics we mentioned, I would argue, the level of technology and IP, intellectual property that they developed, how unique it is, right? How disruptive, is it eroding market share from the competitors? There's a few more, right? And then understanding, did they raise a lot of capital to get there? Were they capital efficient, or are they burning $1 million a month to get to that top line, right? There's a number of them, and we look at them in an internal process. We weight them, and we get to the point: is it sellable? What is it worth? And is it in line with the owner's expectations? And this is part of our job. We do it all the time to understand what mandates we can work on, because we need to be selective, right? And so if somebody is questioning what is my company worth, can I sell it? How far away am I to selling it? I mean, that's a conversation that I would have any day.
That's awesome, and I think that's the perfect wrapping point on this podcast, which is, if anyone out there is trying to assess the value of their business, contact one of you two folks here, run through the process, run through the 12 points, and take the whole entire process seriously and set reasonable expectations. Or any last piece you want to add to that?
Okay, again, just a reminder that your company's only as valuable as the market's willing to pay for it, whatever buyers. So preparation is the thing that most companies don't do well enough to get to that premium valuation, or to achieve their full valuation potential, right? And so, hiring an advisor sooner than later, just to at least give an assessment of where there's holes to fill or things to improve, that's a starting point. And then the timeline depends on how much work you want to put into it, how much you want to prepare.